Hi everyone, welcome back to my channel. Today I'm going to be continuing part 4 of a series where I discuss the exact entries and exits I take as I trade throughout the day using a combination of smart money concepts, volume price analysis, and market maker positioning data. Before we get started, I'll leave several discount codes for trading services I use in the description, including Sonar Labs, Tradytics, and Elite Trader Funding. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. With all that being said, let's get right into it. So this series, so far, I've covered multi-time frame order blocks, high volume nodes, ledges, value areas, and POC using volume profile, VWAP, gamma levels, and of course using candlesticks and volume for confirmation on entering all of those, which are always apply no matter what strategy I use for entries and exits. So now I want to finally get into a specialized strategy I've recently adopted. Doesn't happen all the time, but when it does, it's incredibly effective, and that's the Tradytics Dealer Diary, which is a pretty new feature. And I've talked about this in previous videos, but I really want to discuss exactly how I play these, because we don't just want, like anything, we don't just want to randomly enter in at 3 p.m. when this data kicks in. We want to wait for a perfect entry opportunity and then ideally get a sniper entry from there. After that, we'll talk about some swing trading stuff. However, I did realize I do need to do videos on options billing and option spreads using dealer positioning, and I've already done videos on market decks, but we'll talk about that shortly. Always remember that whenever you're trading, here I'm discussing my entries and exits, but I'm not mentioning how I always keep market awareness in mind. So that means making sure we're aware of any upcoming market events, looking at VIX, looking at ADD, looking at sectors, looking at indices, looking at market net flow for options flow data. All that stuff plays a huge part, and I've done several videos on those, so I'm not going to go through all that stuff again here, but it's a very important concept to understand and always have in the back of your mind as you trade. Now, the final hour of the US session, so 3 p.m. Eastern time, we can apply this new feature called Dealer's Market Diary. And what I want to break down, because there's been some confusion about it, and I want you to look at September 30th, 2022 here in this candle we had and how that corresponds with the zero line. So in past videos, I've talked about how when we've had a bunch of deltas below this zero line, it resulted in with a ton of market maker buying end of day, which really drove price up. And usually that happened on down days, and that looked like it was just a massive downtrend. And then right at 3 p.m., all of a sudden, market completely turns around and we go on a massive bull run. And that's because of these deltas that are below this zero line. And what this indicates when these red bars are below this zero line is that there's been a lot of put buying from institutions and retail traders, and those deltas are expiring off. So that put buying initially caused market makers selling in order to hedge that put buying. If we think about how that's hedged as price moves, as we push into negative gamma, we'll see even more as price moves down, pushing into negative gamma areas. It will result in even more market maker selling, hedging those deltas as we move lower. Then all of a sudden, a particular date comes around, and those deltas that were hedged are rolling off. So now market makers have to de-hedge. And that results in massive moves when the deltas exceed 2 billion, or when they're at 2 billion, or but in this case at negative 2 billion and below 2 billion, we saw all that buying occur. Now this past Friday on September 30th, we saw the exact opposite. We saw a whole bunch of selling occur, and the selling was big enough to actually blow through a very significant gamma level, which was the SPY 360 level, which had been a low for quite a time. And this selling was significant enough to actually defeat that level. And what happened here is we had a whole bunch of institutional call buying, which led to these positive deltas, and put selling, which led to positive put deltas here. And we can see it was at that magical 2 billion mark in deltas, right? So now all of a sudden, it's end of day. The day was actually moving lower all day. And then we have all these deltas these positive deltas that need to be de-hedged at expiration, so that final hour. And that led to this massive selling that I'll show here shortly. And so this is a bit of a cheat sheet that I didn't include on my last video, but we can say when calls and puts deltas are greater than 0, we can expect market maker selling end of day. When calls and puts are less than 0, we can result in market maker buying end of day. The more deltas on one side, the greater the move. So deltas at 2 billion or more lead to significant moves. So when we see it skewed to one side like this and it's at 2 billion, we can expect a significant move. And so as that final hour approaches, where market maker algorithms kick in to do that de-hedging, that's when we want to try to play off the closest order block or low volume node gap or high volume node ledge for an optimal entry. And if you don't know what that is, make sure you watch part 1 and 2 of this series to get an idea of how to use those, how to draw order blocks, how to find those low volume node gaps or those high volume node ledges. And so this is a screenshot, and I'll talk about this day a little bit, but essentially what we had was we had a bear. Now this is ES on the 1 minute that you could have also played SPY this exact same way. We had this bearish order block that was created. The reason this bearish order block was created was because of we had a break of structure. So we came down, made a low, made a new high, made a lower low. When this lower low was created, we made a bearish order block. So again, check out part 1 of this series if you're not sure what that is. At the same time, we can see we had this high volume node area, which created these ledges and then this volume gap, which I talk about in part 2 of this series. Below us, we had this massive gamma level, which was creating all kinds of support. It also correlated with the 200 SMA and the weekly chart, and that didn't really look like we were going to be able to blow through this area. However, when we factor in that delta de-hedging for market makers selling, all of a sudden we defeat that level, which was very significant. I was quite surprised to see that blown out, and it really took this dealer diary. It was just perfect showcasing of how useful this tool is end of day. Now 3 p.m. hit, and we don't just instantly want to sell, because 3 p.m. hit and we actually have this big run up at first, and you might be thinking, oh my gosh, dealer diary failed me, I'm going to lose a bunch of money. Well, that's why it's very important to time our entries. We want to try to time it off of a volume ledge or an order block. And then sure enough, I think this was 3:06 p.m., somewhere around there. Those algorithms start kicking in and start doing some de-hedging. We cover this fair value gap. We can see that initially this gamma level created a bullish fair value gap, and then we just sort of eat through that. We create some more fair value gaps, get bought up again, and then create another fair value gap. Just shows the strength that was sitting down here at this gamma level. But this order block holds once more. We have the MM selling kick in, and we start chewing through it. This time, when the buyers get triggered from this gamma level, we see significantly weaker price action here. There's no more fair value gaps getting created. Market maker seller keeps occurring, and then eventually we blow through it. And this was all forecasted by that dealer diary, which I'll show the chart now so we can talk about that some more. So again, here is now. So I have this up on the 3 minutes, so it looks slightly different, but same thing. We have the whole day. Well, not the whole day, but basically we're in a downtrend after we rejected this big order block up here. Had a nice sell-off. We're making lower highs, lower lows. We create an order block up here on this lower low. Come back up. We're rejecting. We don't even get back to the order block. We just reject out of the fair value gap, which is also correlated with a volume profile volume gap, and we reject again, moving lower. So at this point, when we have this break of structure, we have a break, we have a new high, and then we have another break. We create a fair value gap right here off of that movement. I highlighted this dotted line, which shows this volume ledge, which can help us with precision entries. On top of that, we had a large gamma level that was right here. And this was actually the 360 level on SPY, which had been a significant point, not just for today, but for prior days as well. So if we open up the Tradytics dealer diary on that day, we can see on September 30th, end of day, we have all these positive deltas that needed to be de-hedged. And at the time, actually, this isn't accurately showing it. Thankfully, I do have that screenshot showing those deltas, which were actually significantly higher. They were closer to 2 billion. This is showing them still pretty high, a little bit over 1 billion, but not as high as it actually was at the time. And so when we saw that, we know that market maker seller is going to kick in. So 3 o'clock hits, we get this big green fair value gap. It looks like this is going to be totally ignored. However, when we reject out of it at 303, basically, is when we get this bearish candle. We still see buying. We still see it pushing higher. Then at 306, it starts to reject, and we can take our short entries out as we reject out of here. And honestly, taking profits at this gamma level is perfectly fine. And if you did that, you even get a second opportunity at 330 to take another entry. Now, this rejection happens even quicker out of this order block. And the reason I say that is we can see from this long wick, we just touch it and reject. So we're moving up, candle opens, come up, reject hard, come all the way down. That's an indication that there is strength still in this order block. And then we come back down, and this time when we touch this gamma level, we don't get nearly the reaction we had before. And we could see that sellers are just really pushing these buyers back, pushing these buyers back. Even if you took profits off here, you could use this volume gap to take these ledges here to take some sort of entry off of these wicks as you see sellers doing what they do and pushing this thing down. Doesn't have to be an order block. If you missed entry point 1 and 2, we could have used these wicks along with this volume gap. That's perfectly fine. I take entries like that all the time. And then sure enough, we defeat this gamma level. All the buyers that existed here have been consumed and actually now become sellers. That's typically how this stuff works, is where there were once buyers, the algos will flip and there will be sellers. Now, we continue selling off until we get to a point where we hit this is actually an ES gamma level. This I talked about this in part 3 of my video series here, but if we look here, this core, so if we have 3600 on SPX, that will actually correspond with 3594 on ES. So you just subtract 6 there, and then you can put a big line to make it easier to visualize, so you know it's a gamma level. You can even add text if you'd like, so you know, okay, I have a gamma level on ES here, and this gamma level actually did indeed hold. And just keep in mind that gamma levels, I can't really draw the line thick enough here. It gets indicated better by these lines here, how the range that they can impact from. But we can basically see we come close enough to it, and then we do push higher, we reject off the volume gap, and then we get to close a day. But this whole break was forecasted by that dealer diary, and that's what I want to talk about. Is this is now one of my strategies. So as we discussed, I play off of order blocks. If order block creates fair value gaps and has other indications of liquidity around it that indicate that we will get good moves out of it, I'll play those order blocks with confidence. I pair it with volume profile and volume gaps, and I also use VWAP and gamma levels. And what was fascinating about this particular trade is that dealer diary forecasted that this market maker selling was going to be significant because of the amount of delta D hedging that occurred, but also pretty much every one of the concepts that I use and talk about throughout this whole series played into this. Now, the VWAP did not. That's okay. We were pretty far away from the VWAP. It did play a part earlier. And if you had taken this short entry off the VWAP and just held, you would have had a significant profit there. And I'm not saying that that's something you should have done, but it's a possibility, and it would have been a massive, massive win, especially once we did break that gamma level. But of course, we have no way of knowing that's going to happen. But then again, you could look at dealer diary earlier in the day, and if it does look like it's going to lead to market maker selling, that might be incentive to hold. It's something to consider. But as of now, I use it to play that 3 p.m. hour when we see deltas stacked in a meaningful way like this. And so we can see the next time that we might get something is October 7th. However, it's only at the 1 billion mark right now. If we see this drop to 1.5, 2 billion, I'll be looking for a lot of buying end of day on October 7th to push price higher. Definitely going to keep an eye on October 21st. This is exactly what we're looking for in terms of delta stacked. I don't like that there's deltas above the zero line because that is the opposite of what we want. This means market maker selling, but still it's heavily outweighed by the buying, so we still should be okay there. But again, this could change dramatically by then. It's meaningless when it's this far out, but it's something to keep in mind. And I love this as part of my strategy. It has led to some very significant wins on many different tickers, whether it be NQ, you can use it on NQ, YM, IWM, you can use it on whatever you want, really. So just some tips on that. Use the end of day to determine how dealers will de-hedge the deltas that are rolling off. The greater the deltas on one side, the bigger the move. Use candles and volume for confirmation, hammers, shooting stars, spinning tops, engulfing dojis, things like that on higher ultra high volume. Combine it with order blocks and volume profile, as we just showed, for very powerful optimized entries. And then just make sure you understand the concept of what it's showing you before you go and apply it. I did a video about it. I had a lot of people sort of getting it wrong. I don't know if it was I did a poor job conveying how this information should be used, but just to reiterate it, call buying and put selling from the customer side creates positive deltas on that graph. So initially, it's hedged by market makers through buying of shares or futures. When those deltas expire, market makers are going to sell to de-hedge those deltas. And then the opposite is, so basically calls and puts greater than 0 equal market makers selling end of day. And then the opposite is true when we have deltas less than 0. Call selling and put buying from customer side creates negative deltas initially hedged by market makers through the selling of shares and futures. When those deltas expire, market makers buy to de-hedge. So again, puts and calls less than 0 equal market maker buying end of day. So that's how that gets used. Now, I was gonna talk about swing trading concepts in this series, but decided I need to actually that warrants 2 videos on their own. If you want to look at how I use market decks and to have some significant wins when swing trading, make sure you check out these videos that are listed here. And then the options willing and option spreads videos using dealer positioning will be covered in the near future via their own videos. And then just one thing I want to start doing soon is I can't do this during the day because I do work full time. However, I want to start doing live overnight trading using order blocks and volume profile. I can't use dealer data overnight, of course, because the options market is closed, but I can use VWAP, volume profile, order blocks. They work incredibly well overnight, and use them to trade my 100K funded prop account. So I plan on doing live streams, and maybe we can have conversations that I can answer questions and take trades. And I think it will be a lot of fun for us to do. And that way you can trade with me, or if you have questions about stuff I've talked about in prior videos, or you're just curious about something, I'd be happy to answer those questions. So I'm looking forward to that. And as always, I appreciate you watching.